Hi, I'm here with Tayo Femi-Fowode. He is a graduate from Columbia University with a master's in business administration. He focused on investing, and so I'm really excited to talk to him today because in my mind, I think he's like one of the biggest experts we'll be talking to this year. So I'm really pumped to have you on, Tayo. And Tayo, tell us a little bit about yourself.
Thank you, Chester, for having me. I'm not an expert, by the way, but thanks for that introduction. Like you said, I'm Tayo Femi-Fowode and graduated from Columbia not too long ago, my MBA. And I had returned to Columbia after 10 years. First, I did engineering, chemical engineering. So I'm excited to be here. Let's talk about a little bit of investing, what I've learned over the course of my program and over my personal investing life.
Yeah, you're very humble. Columbia University, correct me if I'm wrong, isn't that where some of the great value investors learned about investing?
Absolutely. I actually did go there because I learned that. Warren went there. I wanted to go there and learn what he learned. Well, yeah. I did that or not, the future will tell.
So, as I told you, Tayo, usually if someone isn't too good at investing, I like them to ask me questions, but today I think I really just want to ask you questions. We really, the goal of this video is really to help people get into investing. So even though I want to ask you some more complicated questions, maybe at the end, if you let me, I'll ask more complicated questions. But really, I guess the most basic is to start off with, for an investor that's starting off, that didn't learn investing and has to do it from scratch, what is the best method to start investing?
That's an interesting question. I started investing in treasury bills. That's okay. For a new investor who doesn't know much about investing or is worried about getting it wrong, it's almost like a baby. You have to crawl before you walk. And I think investing in treasury bills is a way to kind of get started without really taking on the risk. Treasury bills are considered risk-free. So you can't forget about losing your money because you're not going to lose your money. And then you can start doing that just to start to understand how your money grows, interest payments, how you go, you lay out capital and then you get your capital back plus interest over time or at the end to kind of get a feel of it. And then once you're comfortable, you can start to really now think about what you really want to do, whether it's equities and stocks or real estate or whatever it is. I think that might help you to kind of get started without taking any risk.
Great. Treasury bills, for those that are really new to investing, essentially is you buy some of the U.S. government's debt. That's pretty much it, and they pay you interest. So that's why, in theory, they should be relatively risk-free. I always say in theory, because everything for sure can sometimes not be for sure.
Right.
I'm surprised that you started off with that. That's very interesting. In terms of getting into T-bills, would you, for a new investor that only knows about stocks, would you suggest T-bills first, or would an ETF in T-bills and bonds be a little too much?
So, and like you said, I said T-bills for brand new investors. I would think, in my mind, when I think of investing, the first thing that comes to mind, more importantly, is capital preservation. If I don't make $1, at least I don't want to lose $1. So if you are that conservative and don't want to lose your money because you're starting off and you're kind of testing the waters, right? T-bills will preserve your capital.
Awesome.
If you're a little, maybe a little seasoned or you have a little more tolerance for risk, then you could also start off with like ETF or index funds. I think for a new investor trying to pick stocks is, even for seasoned investors, picking stock it's not an easy job. It's difficult.
Yeah. To get into value investing, what would be the first things that you would expect someone to do and learn before they jumped into value investing?
Good point. And this is where we start to kind of maybe talk about your psychology, right? I think everything is important, right? There's a book by Howard Marks. It's a great book around value investing, and it's called The Most Important Thing. And this book has, I don't know, maybe 12, 13 chapters, thereabout. And every chapter is the most important thing. Isn't that kind of funny? So he was funny like that. But everything is important. But I think one important thing also is your psychology, right? At some point, once you start to invest, you need a little bit of math. You don't need advanced mathematics. You just need to be able to add and subtract, and you'll be fine. But before we even get to the math and figuring out, oh, if I give you this much, how much am I going to get back? What's my expected return? It's just to think about your psychology and your psyche. Kind of like prepare your mind for the investment world. And in my mind, Chester, I think this is 50%, if not more, than half of investing. 50 to 70%. If you get that, you've got it about 50 to 70%. And the 30% is the max. And when I say psyche, it's almost like understanding the market cycle. When are you going in and when are you coming out? And if you're going to be investing in like securities, like equities, stocks, you have to be able to understand the nature of what you're getting into. It's going to go up, it's going to go down. And how you're going to react when it goes up and when it goes down. And that's the piece I think most people miss.
Yeah.
Just a little more about cycle. Like you just mentioned not too long ago that when the market went down, you thought about buying more.
Yeah.
That's profound. Not a lot of people think that way. When market goes down, people want to sell and just like, oh my goodness, I don't want to lose my money. I'm getting out.
Oh, I'm a very like my strength is also my weakness when it comes to investing. I'm very good at knowing, okay, we're probably bottoming out. This is getting really exciting. My failure, and something that I learned as a hedge fund manager, was the reality of momentum. Momentum is a very real thing, and it comes because my belief is it comes from the lack of knowledge in the market, and that's throughout. That's Wall Street down to retail investors. There is just a percentage of investors that don't have enough knowledge, and they are going on momentum. It's even part of their strategy. They don't even want to know. They just want to go into momentum. And I think that, momentum is now part of my psyche, that I think, okay, logically, this is the end. This stock is overvalued, but I need to wait longer because I need to let momentum take its stand. So it's a very logical thought process of why I put that on myself. But I wouldn't suggest that for other people.
There is a branch of investing, just like value investing, that's called momentum investing.
Yeah.
People just buy what's going up and they sell what's going down.
Yeah. And
without really figuring out fundamentals or anything like that. You just buy it. I mean, people have different strategies. The interesting thing about investing is that you have to be humble. Just because you made money doesn't mean you made the right decision.
Yes.
Make the wrong decision and buy the wrong security, and it turns out in your favor. So don't get super comfortable and feel like, oh, I think I know what I'm doing now.
Yeah.
And at the same time, you could make the right decision and still lose money. Don't beat yourself up. You've done your due diligence. You think you did the right thing. And so there's an element of luck in investing. And I think we have to remember that and be very humble.
Yeah.
About whether you're losing or you win. Just remember, just because you made a bunch of money doesn't mean you did the right thing.
When I was 12, I did like my first investment. It was in Ford. And I literally doubled my money a year later. I made 100% return. I did not copy that success for another 20 years. I didn't get that same return until this year during COVID-19. So I've been trying to beat my 12-year-old self at investing for 20 years. So
Interesting.
it's just got to keep going and keep trying, and you'll be successful.
Yeah.
So value investing, for someone new to value investing, tell us about it and why it's something you should do as an investor.
So it's a way of thinking, and it's a way of actually investing. And first of all, you have to understand in value investing, there are other ways of investing. And some people will do maybe technical trading, they'll do momentum, but value thinks about, you're not really buying shares or buying stock. You're buying businesses. You're buying pieces of businesses. And Warren Buffett and most other value investors talk about this all the time. You're buying businesses. So the one important thing about value investing is, think about it for a minute, that if I wanted to buy Facebook, or Amazon, or any company, the way I figure out how much it's trading for is I check on the exchange, right? How much is Facebook today? How much is Amazon today? But with value investing, you have to assume that there is no exchange. And if there's no exchange, you have to figure out the price yourself. So there is no, stock market to go to figure out the price. And you are then forced to actually go into the financials of the book and come up with your own pricing. So you have to think about every business, like if you were never quoted on the exchange, or if you're trying to buy a private company that doesn't have a price. So the act of value investing is actually coming up with that value analysis or price that you think the company should be going for on your own. And once you do that, this has to do with a lot of, thinking about, their markets, their profits, their balance sheet. Once you do that, then you look at the price. And if you think a company is worth $100 and it's selling for $300, you'll be like, I think that company is overvalued. I'm not going to buy it.
Yeah.
If you think a company is worth $100, then you have to be like, just like we said, maybe I was wrong in my calculation. Maybe something is happening that I don't know about. So you have to take some margin of safety. If I think it's worth $100, I won't buy it more than $60 because I may be wrong. I'm not as smart. So if you look at the stock price and it's selling for 45, you'll be like, wait a minute. In my analysis, I think this company is worth $100. If I discount all my errors and margin of safety, I think I'll be happy to buy it at 60. But it's going for $45. I'm going to buy this stock.
Yeah.
And that's the act of value investing.
Yeah. If it isn't obvious, I'm very biased towards value investing. I think value investing is the way to invest. So I'm very biased towards it. I will say, to add on to what you're saying, Tayo, and I say this because, Stockteamup, the app that we built, we want to teach people how to invest, but to make that happen, we're really trying to push a cultural change. So I love that you said that you're buying a business instead of a stock. And I emphasize to people constantly that investing is more about making money. Making money has to continue to buy more companies. It's an inevitable part of the whole thing. But owning something is bigger than just the stock and the paper that you own. It's about owning something tangible in the world. And I don't want to go deeper into that because it's a whole philosophical thing that I have, but it really, I think, is important for people that are new to investing to understand that it's not a slot machine. It's something tangible that you will own out there. So thank you for saying that. I really appreciate it.
Sometimes you have to be true to yourself. Not everybody is going to be a value investor, or not everybody wants to do that. Some people want to trade.
Oh, yeah.
Understand, when you're trading, you're not investing, you're trading. With trading, people don't care about the underlying security, right? It's like if I can buy at $5 and sell at $6, I'll do that all day. And they just trade. But with value investing, before you buy, you want to make sure that it's actually worth what you're buying. Why should I pay more for what I think it's not worth it?
Yeah.
Some people can think about, I don't care what it's worth. I just want it to go up so I could sell.
Yeah.
And that's a different way of investing, and that's not what we're here to talk about.
Yeah. My own theory in my head is that it's best if you're a value investor instead of a trader, because a trader really needs to be in front of the charts during the trading period. While value investing, you can do that offline. You have more time. Is that a fair theory, or is that not? Is that anyone can be a trader?
I think it's fair, given that if you work 9 to 5, you really don't have the time that traders do.
Yeah.
Most of the time, the bargains are there during the trading hours, and you're at work at that time. So you really can't live like that.
Yeah.
So, it's and with the value investing concept, a trader is always going from, you have to be open to the universe and you're picking up what's going on. As a value investor, you have to kind of limit your portfolio in a way. Yes, you want to be diversified, but once you're a value investor, you probably don't have, unlimited securities in your portfolio. You know the companies and you know them very well, and you stick to what you know.
Yeah.
But as a trader, you got to be like, you have to have a big catchment area and looking at what's going up, and then you picking that. Value investors are very, very focused and experts in like specific companies, and they know everything about that company. And that's why sometimes for me, I just pick up 10Ks and I read them. And I particularly like companies that don't have too much of a cumbersome 10K, something you can read in like an hour. It's not like 1,000 pages and but there are some good companies out there. They are not very popular, they're kind of ugly, but they're 10K, you can actually read them, in the span of 1 hour, cover for cover. And you know everything about the company, and your confidence in actually investing in the company, if it meets all your criteria, goes up a lot.
Yeah. Well, good. I want to ask you now I want to ask you some more complicated questions.
Oh.
We're just going to go into that. It's good. So I use the intrinsic value of the company based on how I calculate it, and I use book value, and I use just pure earnings. I don't do discounted cash flows, and I don't use I don't do cash flows. I go purely based on earnings and book value. When you calculate intrinsic value, how do you go about doing that?
I use free cash flow.
You do free cash flow, okay.
I use free cash flow. And when you say earnings, I don't know what to use, but net earnings, it's a little bit of, I'm not sure if net earnings is the right thing to use, right? Because before net earnings is like interest payment. So if the company was leveraged or not leveraged, you probably won't see that. And before interest payment is depreciation and amortization. So I use cash flow sometimes to kind of augment that. I could use EBITDA, earnings before, exactly. I use that. But mostly I try to get the free cash flow of the company. If I can figure out, and free cash flow is how much excess cash does the operating business generates. And I assume that, the business is a going concern. It's going to be around forever. And therefore, they have to kind of maintain their equipment. Like you have to upgrade, keep things clean and replace. So I take out any CapEx expenses and then use the free cash flow. You discount that.
That's very interesting. I haven't thought about doing removal of the CapEx, but I typically do it for businesses I actually run. So
okay.
That's interesting. I didn't even think about that. That's a good thought. For people that don't, like, we just threw a lot of stuff out there, but for people that don't know what we were talking about in some of those cases, what we're trying to do is a lot of the things businesses can use, amortization and interest and taxes, they can kind of sway that, but it may not represent the business business's health and earning money. So we're trying to get through the weeds and try to figure out what reality is of the company's profitability. Is that a fair statement of what we're trying to do?
Yes, yes. Because the government allows, according to the GAP principles, they allow you to depreciate investments you make in, like, property, plants, and equipment and other things. And when you depreciate that, it reduces your earnings. It reduces your net earning. But really, the money didn't go anywhere. The money is still with the company, but now it's off the books,
Yeah.
So sometimes you want to go back to where that is and figure out, okay, this is how much money this company really has, because if they ever go into financial distress, that depreciated cash is there.
Yeah.
The cash they took out for depreciation is there and could be used.
Yeah. So I guess one thing I'll ask is, to be honest, on Stock Boss Up, some of the most popular stock picks that new investors are picking. So we have all this data. We can see what everyone's doing and kind of assess how well people are doing. And one of the ones that they really like to choose are the tech stocks. Pretty obvious, the FANGs, the Amazons, the Googles. Do you ever do value investing on those stocks? And if you do, how do you do that?
I do, but I don't get anywhere with them. I love these companies, and I own them, actually. I own them in, like, my 401k. I don't own them in my personal portfolio. I own them in my 401k, so I'm well diversified. I mean, if you buy the market, you have some of the stocks anyway. But if I do what, like we said, when I look for free cash flow, some of these don't have free cash flow. So I don't know where to start. Free cash flow is what you discount, and if you don't have free cash flow, or some of them don't make profit yet, and it's almost like, if you don't have free cash flow, where do you even begin? So I'm missing out. That's another thing we talked about in the beginning about value investing, with your psychology. It's not only when you win, don't be too happy, and when you lose, don't beat yourself too much, but also when your friends are making money and you are on the sideline. So patience is, like, a very important. You have to stick to your guns. So if everybody is buying a security that you don't believe in, and they're making money and you're on the sideline, you have to be disciplined enough to be like, I get it, but I'm going to stay out. Or until you get convinced and you join the bandwagon. But if you're not convinced, you have to be able to kind of live through that within yourself. And that's a very difficult thing, not succumbing to the peer pressure. Now, imagine if you're a money manager and somebody gave you money and you're like, oh, there's nothing new to buy, or there's nothing good to buy. But he has a friend who said, oh, I have this other friend who's doubled my money. They will probably come to you and say, you're not doing anything good with my money. Let me have it back so I give it to the other guy. So you have to be very, very disciplined. Understand that. The tech stocks, they're great. I want to own them. I own them in my 401k, but I don't own them in my personal portfolio. And when time is right, I will get in. Not right now.
Yeah. Well, Tayo, I really appreciate talking to you. Thank you so much. I hope we can do it again. I love it. It's I could talk investing with you for hours. So thank you so much. Appreciate it. And thank you everyone for watching, and cheers.